something else that I think is worth mentioning in recent results, we talk about pretty solid growth in the first half of 2018. I think revenue growth came in around 34% year over year. But there was a blip also in 2017 that I think really worried investors, basically looking at the story, evaluating its long-term prospects, where we saw a company putting up these incredible growth numbers, but at the same time, the revenue was down in 2017 for Yeti, about 22%, as a result of what the company describes as multiple factors coming together and as headwinds. Can you tell us a little bit about that, Asit?
Sure. So one of the first problems that hit the company was it has been doing so well that many of its partners built up excess inventory. On top of that, there was a delayed merger between Bass Pro Shops and Cabela's, which didn't help. And the negative retail trends, if you think back to just a year ago, we used to talk on the show in the 2016-2017 timeframe about Amazon's effect on retail outlets. So there was positioning there. And then the lawsuits against some competitors who were essentially mimicking the Yeti product line. What happened for Yeti in terms of enforcement is was able to successfully sue some of its competitors, but the courts ordered these competitors to liquidate inventory, and so there was a fire sale on competing products, which hurt Yeti's own sales. In response to that, Yeti in its prospectus has listed a number of items that initiatives that it's undertaken to sort of restabilize and regrow sales, including pricing actions. You can read that as discounting its own products. That's to make sure that they restimulated demand. But they've said that they've done that without hurting their sort of premium positioning. Focusing, as Vince mentioned, on this DC channel, especially the digital channels, which are associated with that. The company culled about 1,100 underperforming retailers to get to that 4,800 number that Vince told you about in terms of retailers today. So cut out the inefficient ones who weren't that profitable for it, and increased engagement with Dick's Sporting Goods, which is the country's largest sporting retailer. A couple more I'll mention that were listed in the perspective: rationalizing the manufacturing base. That simply means they cut down on the number of manufacturers to get better production deals out of the ones that were remaining, and adding those executives we talked about, as well as more employees, including those that work on product developments. One of the things that's really characteristic about this company over the last year is it's really ramping up the number of products it offers, especially, as I said, in the drinkware categories and the other categories. The other category includes T-shirts, hats, and even dog pet bowls.
The bowls, the accessories. I saw that in the prospectus too. So, I mentioned this before. I think management does their best trying to explain for 2017 why they're all of a sudden this incredible growth trajectory really just flips like a switch and goes in the opposite direction. But for any young company that's going public, you're going to have a hard time building as much confidence in investors when your most recent full year results show, that a double-digit revenue decline, net income down 68%. And then at the same time, some investors are already going to be feeling worried or concerned that the company is riding a wave of almost fad-like popularity, and there's no guarantee that it's going to have staying power, being kind of this top-of-the-line cooler and drinkware brand. And that was ultimately reflected in the initial public offering process itself. We haven't talked as much about this, but CoreTech first filed to take Yeti public back in 2016. But after 2 years of sitting on the shelf, the deal was pulled earlier this year, only to be refiled. And eventually they were able to price the deal in October, so late October, at $18 per share. And that was below the range of $19 to $21. And then following kind of in that vein, the company's first day of trading was October 25th. Shares closed at $17, so below the pricing, the offering price. And as of this recording, shares still haven't managed to clear that original $18 pricing level. So that kind of weaker IPO performance, down trading, it really does, I think, serve to reflect the concerns that investors have about long-term growth and positioning for Yeti. But keep in mind that with this IPO, Deal size was $280 million, but Yeti itself only pocketed about $37 million of that in terms of the proceeds. The remaining proceeds went to CoreTech, which reduced its ownership from the originally around 70% to about 55%. I found a source that CoreTech acquired its initial stake back in 2012 for $67 million. So at the IPO valuation, that $67 million investment became $1 billion of holdings. So a pretty solid return for CoreTech in 6 years' time.